has historically been one of the bigger growth stories of the basin that we've seen out of energy companies, but certainly has turned to a free cash flow profile and a more moderated growth in capital spend. So very pleased to have Marty with us here today, and I'll let him kick things off with a few comments that he'd like to make sure we all leave with, and then we'll kick it into Q&A. So please feel free to submit questions on the app, and I've got a handful here too that we'll get through. I'll hand it over to Marty.
Thank you, Jamie, and thanks to you and CIBC for including 7 Generations in this conference. I like the new venue. I want to start by saying I've got an advisory on forward-looking statements in the appendix of this. I'll probably flash it when we get to the end of the slide, or end of the slides. So we just have a few slides to go through before we get to the questions, just kind of an overview of the company. First off, 7 Generations is a focused and specialized Montney developer. We have, I think, an advantaged position in the Montney. We have a very large position as well. We're advantaged both geologically and geographically. Geologically, we're in the deepest, I think, one of the sweetest spots in the Montney because we're very liquids rich. Geographically, we're just 100 kilometers south of Grand Prairie, so great access to supplies and service providers. Also, a great community that supports oil and gas development, and we've worked very, very well with that community. It's important to us, both the city around Grand Prairie as well as the Indigenous communities where we work. So that's important. I would say, just ballpark numbers, we've got about over 500,000 net acres, more than 800 net sections of Montney rights in our Kakwa region. We have worked a lot over the last couple of years to expand our inventory. We've done some delineation work late in 18 and through 19. That's pushed the edges of our Nest 3, Nest 1, and Nest 2 upper Montney areas, and we've added some lower Montney. So I think we've got near 2 decades, near 20 years of top-tier drilling inventory ahead of us. And on top of that, 3 or 4 more decades of prospective opportunities. So we've got a great inventory of land in, I think, one of the very best drilling areas in North America. And that comes through as well. If you ever have a look at the top well lists that are put out by a few analysts, we are consistently among the top wells in North America. We are consistently delivering some of the top wells in North America. We are now about 200,000 BOE per day. Last year our guidance was 200 to 205,000 BOE per day. We are the largest condensate producer in Canada, around 75,000 barrels per day of condensate. It is the most valuable product in Canada. And I'll get into condensate pricing probably a bit later, but we're very happy to have that exposure to a premium product. We also have done a very good job with egress, and that's part of the infrastructure that I mentioned, part of the geographical advantage. We have 2 transcontinental pipelines that go right through our land, so we have secured significant access on both the Alliance and the Nova, or the TransCanada systems. So we've got egress for our gas, we've got a great market for our condensate, and an improving outlook, I would say, for our for NGLs, the ethane, propane, butane. We last year had cash flow around $1.4 billion. Capital program last year, $1.25 billion. This year, our capital program will be about 12% lower at $1.1 billion. And year by year, and I'll get to this more later, year by year, our maintenance capital, our sustaining capital goes down, largely because our declines are mitigating, but also because of some capital efficiency improvements. Our mission, simply put, is to serve all of our stakeholders in responsible development and deliver compelling and consistent returns to our shareholders. This shows the slide, and this kind of relates to what Jamie was talking about in the introduction. On the left side shows our production growth. We went from about 8,000 BOE per day in 2013 to over 200,000 BOE per day in 2018. So in 5 years, we accomplished quite a bit. The focus early on was on growth. So from 14 to 15, we doubled. 15 to 16, we doubled. 16 to 17, we grew by 49%. We went from 118,000 BOE per day to 175,000 BOE per day. We felt we accomplished quite a bit, but unfortunately we disappointed a lot of shareholders in that year because we had promised even more. So that became, we changed leadership in the middle of 2017. We changed our focus. It wasn't about growth, it was about returns. It was about generating value for our shareholders, and growth would not be the input, it would potentially be the output in the right environment. So we slowed our pace of growth from 17 to 18, we grew by 16%. We chose, as we set our budget for 19, and again for 20, we chose to make our capital allocation more about returning capital to shareholders through a share buyback instead of continuing our growth path. What happens as we focus on our execution, as I said, our declines mitigate. That's significant. So with decline mitigation, our maintenance capital goes down, free cash flow profile goes up. We've also gotten a heck of a lot sharper in terms of understanding our resource and being able to predict what we can deliver. And so I would say for the last 6 quarters, if not more, we've done what we said we would do, and that means a lot to us. That focus then on returns and delivering what we promised began in mid-17, and I think we've been successful with that. On the right side, that's showing just our gas. Our gas is about 40% of our BOE. That's showing it growing to about 500 million cubic feet per day. One of the lines shows that our processing capacity, even our owned processing capacity, is about 760 million cubic feet per day in the 3 plants that we have built. We also have processing capacity available through a third party. It was an obligation that we acquired through an asset acquisition in 2016. That takes our processing capacity to over a BCF a day. And then we have egress to premium markets for our gas throughout most of the Midwest, also Eastern Canada, now Malin on the California-Oregon border. So we've been very proactive in securing access for our products so we can have the optionality around growing, making acquisitions, or currently just focusing on improving returns. Just a second on this. I mean, this just shows the trend and improvements of our capital and our operating cost through time. We had some pretty big costs in the early days. We actually changed our program a bit in 2016 and 17. We went from a completion design that was mostly nitrogen foam fracs in 2016 to almost all slick water fracs that introduced some costs. We also changed the way we fracked. We were getting to more sand and actually more importantly more stages for our fracking. So that caused a bit of a bubble in the cost, but we've been working on improving that further. On the operating cost side, that extra water that came with those slick water fracs also added operating costs to handle that water when it came out. We've made a lot of progress in bringing our operating costs back down too. And it continues to be a huge focus for us, managing our costs. That allows us to improve margins. That, again, will allow us to improve our returns. The chart on the left, I think, is pretty important. I mean, that shows that in our early days, as we had that wild growth, we were fortunate in that we had capital providers that were willing to fund that growth. For the first few years of our life, we were able to invest 3 to 4 times more than we made. So our capital programs were 3 to 4 times more than our cash flow. We've gotten to the point now as we've moderated our growth, gotten our costs down, focused on getting the better wells as well. Last year was the first year that we actually had free cash flow. I mentioned what our cash flow was, $1.4 billion. Our capital program was $1.25 billion. Free cash flow was $150 million-ish last year. We haven't released Q4, but that's what we had guided. Also, we invested about $150 million last year in delineation drilling. As I said at the beginning, that expanded our nest, all the areas, Nest 2, Nest 1, and Nest 3 in the Upper Montney, but also gave us more confidence in the Lower Montney, which will become part of our building block of the future. I think it's very important to note that our rate of growth in free cash flow will probably be one of the biggest in the industry. So our free cash flow, obviously it's a result, it hinges on how much capital we're investing, but it also, that capital investment actually relates as well to our decline rate. So as our decline rate comes down 2 to 3% per year, currently just in the low 40s, as it comes down 2 to 3%, our capital required to stay flat goes down. We're also getting some capital efficiency improvements. So our maintenance capital in 2018 was about $1.2 billion. 2019, about $1.1 billion. 2020, about $1 billion. So $100 million of reduction in maintenance capital, the amount of capital required to stay flat year by year. And we think that continues, and therefore, in a stable commodity price environment, which we would all welcome, we should see some pretty good improvements in our free cash flow yield. This kind of puts it all fairly graphically. So it shows in 2018 our capital program, $1.8 billion, sustaining capital, as I said, about $1.2 billion. And then we had quite a bit of investment in other things, including some growth. We grew by 16% that year. Some delineation, some water handling projects to reduce operating costs. Last year our program was $1.25 billion. We had about $1.1 billion of that for sustaining capital, about $150 million for other things, largely the delineation that I mentioned. This year's program, $1.1 billion, $1 billion for sustaining capital, $100 million for value-enhancing projects, and a bit of delineation work. What I want to show here, I think the most important thing is you can extrapolate that out, and as I've talked about, our maintenance capital goes down. you can extrapolate that out and say that it's conceivable by the end of 2022 our maintenance capital is $800 million. And if cash flow is about what it was last year, $1.4 billion, you're looking at $600 million of free cash flow. And at the same time, we're taking that free cash flow and buying back stock. And so we've already bought back more than 8% of the company. If we did the same year by year for the next few years, it's conceivable at the end of 2022, we have less than 300 million shares outstanding. $600 million of free cash flow by 300 million shares is $2 per share of free cash flow, which can get up to a 10 times multiple. That sounds pretty appealing to me with a share price that's currently $7. Final slide, I just want to mention our focus on ESG. It's been important to our company all along. On the left side, we're looking at some of the environmental performance. We've done a very good job, I think, minimizing our surface footprint, reducing our greenhouse gas emissions. We believe the lowest carbon intensity in the business. It's the lowest of anybody that I've ever seen that reports. And we've been focused on improving how we discuss and describe our successes on the environment. And just last week, we received a rating from CDP, it used to be called the Carbon Disclosure Project. We received the best rating of any Canadian producer, an A- rating. There were no other Canadian producers at that A- level. It's in the top 15 in the world, as a matter of fact. On the social side, we've always, as I said at the very beginning, we've actually delivered very responsible development in support of our community, worked well with the community around us, including Grand Prairie and including the Indigenous communities near us. We've focused on our safety improvement, which is part of the social safety. In 2019, our TRIF was the lowest we've ever had, a 0.46 number, 57% better than 2018. So we keep working that. On the governance side, we have also evolved. We've moved from a startup company to a more mature entity, and that includes governance improvements. So we have had, last year we had 4 of our founding directors not stand for re-election. Our board is completely independent, with the exception of me because I'm on management. But we have an independent board. We are very focused on important things like diversity as well. We're committed to the 30% club. Our officer group has 33% females, and our board currently 20%, but we're working to continue to improve that. Just this week, in fact, Monday, Sustainalytics announced that we're now included in the JANSI rating. So all these things are beginning to, I think, build some momentum around our ability to proudly proclaim our performance as a responsible developer, and these ESG scores are proving it out. So as I had warned, here's our advisory notice on forward-looking statements, and I'm now ready for questions.
Thank you for that, Marty. Appreciate all the color there. I guess touching back to the maintenance capital discussion and free cash flow, how would you frame the allocations of free cash going forward with respect to an NCIB, growth, debt reduction, or maybe a dividend? How do you think about those different buckets, I guess?
Yeah, it's a great question, Jamie. It's something we test continuously. I mean, certainly every quarter we talk about that with the board, but every month we're reviewing those capital allocation decisions within the management team. We're committed this year. The capital program this year is set. It will not change even if commodity prices improve. So $1.1 billion is our capital program for 2020. As we look forward, though, the choices become, as you say, growth, dividend, more buybacks, and other potential opportunities. It will depend on the environment at the time. It depends on where our share price is at. When we made the choices in 2019, or for 2019 and for 2020, our share price was, we thought, to a level where we were better to invest in buying back stock in the company than resuming growth. Regarding a dividend, we think it's premature to be thinking about a dividend. It's something that we do consider, and I think it's the kind of way that a mature company can return capital to shareholders. At the moment, though, with our decline still fairly high, as I said, in the low 40s, but coming down, probably we're going to be in the high 30s by the end of the year. With our decline where it's at today, though, we think it's premature. We want to make sure we've got the resilience on our balance sheet before we implement a dividend. I often characterize a buyback versus dividend as dating versus marriage. And so when you're in a buyback, you You can do it if you have the opportunity, if you've got free cash flow and you can allocate that to buybacks. Once you implement a dividend, you're committed to it for life, and we don't want to do that until we're certain we can fulfill it.
Great. You mentioned ESG. That's something that comes up more and more. It's more important to investors than it has been in the past, and it's a huge topic, obviously, to be sure. But if you had to pick a couple of areas that 7Gen is focused on in 2020, key objectives on that front, just a couple. Could you frame those for us?
Yeah, there's several. I mean, I would step back to last year, and me at the very beginning of last year, I was quite disappointed. We knew that we were doing well with the environment. We had the lowest carbon intensity in the business, to our knowledge, but we weren't doing all that well in scoring from the rating agencies. So we stepped up our focus on how we report, how we tell people about what we're accomplishing. So that began last year. It will continue this year. So it'll still be part of our focus in 2020, ensuring that we are not just performing as well as possible, but communicating that performance to others. I think, as I talked about on the governance side, I mean, there's things we can continue to do that we are quite focused on. For example, our board. We're considering adding additional members to the board. I mean, in anticipation of maybe some changes coming up, just as you'd expect some attrition through time. We had a renewal process that started last year that will continue this year. I think, without a doubt, our next directors will be female. That's something that we're somewhat focused on. But it's a continuation of communicating all this, and I think one of the opportunities for us is if we can show that we have a responsible development culture, and if we can get the success on the scorecards from the ratings agencies, I think it opens opportunities for us to potentially create new markets. And we're actually on the verge, I think, of having a new market open to us. There are purchasers of gas, utilities, for example, that want to tell their customers, they want to fulfill their customers' desires to have responsibly developed gas in their networks. And so we are working hard to brand ourselves as that so that we can open new markets for ourselves, and also prove that Canadians, Albertans are responsible developers, and hopefully use that influence to open markets to the rest of the world as well.
Great. On the condensate side, 7Gen is one of the biggest, if not the biggest, condensate producer in the basin right now. Pricing has been really strong over the past 3 months. I guess, what's your view on how that market continues for the balance of 2020? And I guess, how do you think about, maybe a two-part question, how do you think about some of the emerging technologies on the oil sands side or shipment side, such as DRUs and partial upgrading, and what that means for the condensate market going forward? Yeah, sure, good question. And we are very pleased that we're in the position where we are the largest condensate producer in Canada. It is a valuable product. We saw January condensate trading a little above WTI. February looks like it's $1 or $2 below. March, similar, maybe widening a bit. It's pretty thinly traded, and so it's pretty hard to get a good forecast on what condensate looks like for the longer term. But we're very glad to be in that position where we do have that condensate in our portfolio. I want to make a couple of points before I come to the DRU question. One is that our condensate, I think, is somewhat poorly understood. Our condensate currently gets its very best price as a diluent, as a mix for the heavy oils, so that the heavy oil producers can ship it as a dilbit, so diluent with bitumen, and ship it in their pipelines. But our condensate is a bit different than the condensate that we compete with as diluent. So what we compete with is the condensate that comes up on Southern Lights and Cochin. Those are a pentane only. They're a C5H12, which is great as a diluent, not so good for a refiner. What our condensate has, it's an advantage, I think, is that it has a lot of distillates. So we've got diesel, we've got gasoline. It really is a very, very light oil. And so when you think about the outlook for condensate, it's not just diluent or zero, it's diluent or light oil. That's the fallback. And in fact, because the most desirable condensate, the most desirable diluent is the C5H12 that comes up from the States, we actually get a bit of a penalty on our price for condensate because the density is a bit higher. So we have, over the last year and a bit, taken some of our most dense condensates over to the east side of our development and handled them like not heavy oil, but handled them like oil. So we've actually installed some oil-like batteries. We take the condensate from them and sell them into light oil streams. Then the remainder of our condensate is actually lighter, and we get a better price for it.
So the outlook for condensate is good. Now to come back to your question about DRUs, the diluent recovery units. Look, we actually don't see those as a threat. What we see that is probably increasing demand. The reality is that the DRUs are not going to compete they're not going to compete with pipeline capacity. So at a minimum, the current pipeline capacity gets filled. That's the best pricing that the bitumen producers can get. Our expectation is that Trans Mountain expansion proceeds. That increases bitumen demand and condensate demand. Probably Keystone XL goes. Probably the Line 3 expansion into the U.S. goes. I think those will all be preferable to the heavy oil producers versus a DRU. The DRU is really just, I think, their attempt to increase transportation for their bitumen to markets in the United States. But the reality is, even though the diluent and bitumen, the dilbit that gets shipped on pipelines is a bit different than the neat bit that will get shipped from a DRU, the neat bit still will have some condensate in it. And my opinion is that there's actually going to be an incremental demand for condensate, not an erosion of demand.
Great. Maybe switching into some of the assets here. So, I mean, you guys had your Gold Creek facility in strategic process announced about a year ago. Can you offer any updates with respect to that process and how it's shaping up? And I guess maybe two-pronged question here too, but if we think about future infrastructure for the company, given you're in a bit of a low growth or more moderated growth type of profile right now, what are some of the bigger ticket infrastructure items that might be a few years out for 7-Gen? So,
well, I'll start with the second part of your question first. I mean, the reality is we've got more than enough processing capacity to meet our growth ambitions for quite a long time. We currently produce 500 to 550 million cubic feet per day of gas. We have owned processing capacity of 760 million cubic feet per day, plus access to third parties processing for another 250 million cubic feet per day. So more than enough processing capacity. We actually have more than enough egress as well to take our gas to the Midwest or Malin or to Dawn. So we're in a very good spot for our own ambitions. Therefore, to your second part of that question, I don't see us having material infrastructure costs over the next quite a long time. On the first part, I mean, I'm tempted to say no, I don't have an update, because the challenge is that we really shouldn't have been talking about it very much. I mean, all we were saying is, look, we've got this unutilized capacity. We would like to utilize it more so we can generate some additional revenue, make more money for our shareholders. That took on a life of its own. People thought, well, what if you sell all that capacity for $1.5 billion, buy back 2/3 of the company? Then it began to get too much noise, and some people that rent our stock decided there was going to be some trading opportunities, and then they were mad when we didn't do that. Like, we've got a very strong balance sheet. We don't need the capital for, we have access to capital. We've got an undrawn line of credit for $1.4 billion. We're very strong financially. So it's not that we want to take that infrastructure investment and monetize it and then pay a fee for the rest of that infrastructure's life that will erode netbacks. That wasn't the purpose. What we were contemplating was an ability to take that investment that we'd already made, and in fact we made it when we thought we might be growing more rapidly, but we changed our pace of growth, take that underutilized investment, find a way to fill it, and find a way to get more revenue. One of the issues that we have is that the way we do our super pads, we actually compress our gas on the way off of the super pad, so it arrives at our processing plants at high pressure. Most companies don't do that. So if we want to take third-party gas and use it and process it in our plants, we would have to add additional compression at the front end of our plant so that we could essentially pull the gas from third parties in. Also, most third-party gas that's available has some H2S, some sour content. All of our gas currently is sweet, and so we haven't invested in amine systems or H2S handling systems in our plants yet. So to make those plants capable of taking on third-party volumes, we would probably have to make investments in compression and H2S handling. The capital allocation decisions for us aren't for that. Our capital allocation decisions currently are maintaining production and then investing in share buybacks. Eventually it might be growth. Growth is still going to be more profitable for us when we have the great quality of Montney resource. It'll be more profitable than investing more money in that plant. So what we had contemplated is, can you bring in a third party that might want to invest in upgrading those plants to handle third-party gas, and that might have expertise in contracting third parties to process gas through us. That may not happen, and The reality is we like the redundancy. We have more than enough processing capacity, so if a third-party plant goes down for a 3 weeks maintenance that actually takes 5 weeks, we're not hung out. There we have the redundant processing capacity, and we can handle disruptions that might occur in our infrastructure. So we're in a good spot. We have lots of optionality. We're not going to rush to a decision that might not be best for our shareholders in the long term, but we're going to try to talk about it less.
Sounds good. How about the Lower Montney? How should we think about that going forward as part of your drilling mix in any given year, and how do you frame that versus what the opportunities that you have in the upper and middle?
We're excited about it. I mean, our decision to invest in 2018 and 2019, to invest in delineating that Lower Montney was deliberate. I was becoming concerned that we might have been compromising the lower by developing just the upper, and so it was important, I thought, to learn more about it. And it's been a big focus for us for the last couple of years, doing the science, understanding the type curves, making ourselves in a better position to predict what we're going to be accomplishing with all drilling. And the Lower Montney was just part of that evolution of science. We're very pleased with the Lower Montney results we've achieved. We've actually exceeded expectations. We thought we might get a Lower Montney result that was about half of the upper. Turns out it's probably 3/4, if not better than that. So we are encouraged, yet it's too early to declare victory and say that everything going forward is going to be a triple stack. We want more data. We want more time. The reality is that, and this was kind of what we did in the early days of the company, if we want to maximize free cash flow, if we want to maximize cash flow and free cash flow, you would just do the Upper Montney and the Nest 2. That's what we know the best. It's where we think we probably get the best free cash flow. But to maximize the net asset value, I think we're better off integrating all 3 Upper Montney areas, Nest 2, Nest 1, Nest 3, and some element of Lower Montney. That will preserve the very best of our inventory for longer. And the Lower Montney, if you consider that it's a tag-along to the upper development, the upper's carrying then the cost of the surface facilities, the lower becomes a half-cycle incremental economic, and it actually competes fairly well for capital. So with time, I think we will get towards to where the building blocks are mostly triple stacks. We have a lot of inventory at Lower Montney. It's pervasive. It exists everywhere that the upper exists. So lots of opportunities there for the lower development. This year, we're going to have a lower well probably on about 30% of the pads. It'll be about 10 to 15% of our well count, but I think that increases in time.
Sounds good. Probably last question here. I guess when you think about the landscape of the Canadian energy market right now and the valuations that producers are trading at, how do you think about M&A for 7-Gen versus the organic opportunities that you have? Like, is M&A on your radar screen at all, or should we think about 7-Gen effectively looking just to organic development for the next few years?
Well, I'm glad to have this opportunity to address that. I mean, we're involved in an acquisition right now. We're buying back some of the best Montney assets in the world. We're buying back our own company. And so it's part of our focus. We do evaluate a lot of other opportunities. So we are thinking that is probably something for the future for us, whether it's a merger of equals or us becoming the consolidator. At the moment, it's not a focus. We think we've got much more to do on our own inventory, and the organic opportunities we think outweigh the opportunities that might come from other assets. We truly believe, and you can see it in the well results, you see it in all the studies when people do their supply cost curves. Our Montney, the Kakwa River Montney, is some of the best resource in North America. And we've got lots of it. And we've expanded our inventory through our Lower Montney delineation and the pushing out of the edges of Nest 1, Nest 2, and Nest 3. And so we're confident we've got a lot of organic room and that acquisitions are not essential for us for a long time.
Perfect. Thank you, Marty, for your time. Appreciate it. And thank you, everybody, for being here.
Thank you all. Thank you, Jamie.